Hello, everyone, and welcome to Moementum Finance Channel. For those of you who may not be familiar, my name is Mo, and I'm a DIY investor here in Canada, mainly taking on the approach of passive investing through low-cost index funds. My wife and I have been investing for the past 6 or 7 years, and over the years, we've learned a lot from our mistakes. When we first started investing, we started with investing in individual stocks. Robo-advisors was part of our journey as well. And through that journey, we made a lot of mistakes, from picking individual stocks that were speculative, listening to the tips that you hear on different shows from Jim Cramer to YouTube and whatnot, blindly without really doing our own due diligence, picking penny stocks, chasing high yield dividend stocks, so on and so forth. But over the years, ultimately, we landed on a more refined strategy and approach towards investing that gives us that freedom and peace of mind. We are investing now through a select few high quality, low cost index funds. These are more broad market index funds that gives us global diversification and allows us to easily sleep at night. I'm not kidding you. In fact, if you look at our portfolio and a few of my past videos, you see at one point our portfolio was down over $30,000. But as I indicated in that video, over the years, I've learned my lesson that with investment, when you're investing in the stock market, as long as you're invested in the reliable companies or index funds, in our case, you're not going to lose any money unless you choose to actually sell your holdings. In our case, because we are invested broadly through those high quality index funds, we did not panic. We hold on to our kind of thesis and wanting to continue to buy the same type of funds that we had in our portfolio at the prices that we were offered, which was lower than obviously what we bought for. That's why our portfolio was down. And even though we are not fully out of that, if I show you in a moment, even though we are not out of that state, you do notice that our account still is showing some negative loss. In fact, unrealized loss of $8,398, but it's a lot better than where it was. In fact, down almost $30,000. And we are very happy with it. We've actually, my wife and I have been aggressively buying into our shares of XEQT. This indeed right now is our largest position in our portfolio, accounting for, as you notice, close to 92% of our portfolio at this time. The rest of our holdings here includes shares of VT and VTI, and you do notice how these funds are kind of performing for us. Currently, our shares of VTI are up by 2.1%. However, our shares of XEQT and VT are both down by close to 1.8%. In saying though, I want to also bring out to your attention, the total portfolio value size that you see here is kind of a result of an effort that we've put into place over the years, and this is not just the results of returns from the market. You see our returns has been quite actually subpar, and I attribute that to a lot of it to our strategies. We've changed our strategies a lot. We've learned from our mistakes and done a lot of horrible mistakes. And I think that's why in making these type of videos, I wanted to share some of my learnings in the hope that others who are just starting investing or maybe are not as experienced investors hopefully learn from some of our mistakes and can course correct accordingly to based on their own risk tolerance and what they see fit for their own portfolio. This is not financial advice whatsoever. It's mainly sharing my own journey, what are some of my lessons learned, and how I envision our portfolio to be in the next few years as we aspire towards reaching that financial freedom stage for us. We did have a property sale about a year ago. I did touch on that in some of my past videos, and that really helped us accelerate this portfolio a lot. And so since last year, if you see some of my older videos, you see that our portfolio size has grown a lot because we repurposed a lot of those capital gains from that real estate property sale and kind of funneled them into buying more shares of the funds that we have in our portfolio. That's why the return, I don't think it's actually quite accurate if we just look at the total return, because this portfolio was much smaller in size, and also the time that you're buying different funds play a part. For us, this year or beginning of 2023, I would say is a more of a fairer baseline as we see how we truly we ourselves are gonna assess the return for our own portfolio, because that's where from then onwards, we kind of strategize and decided on what is our approach to investing in the market. We are going to stick with that low-cost index fund investing. I do see us pursuing this approach for at least the next 10 years with the focus on the total equity stocks, which is a nice segue to the intro of this video that I talked about. I wanted to compare 4 different funds. These are all 4 funds that allow you to invest globally into the stock market through an all equity exposure. By all equity, I mean 100% of your funds are going to be funneled into stock market, no exposure to bond market or fixed income. I was recently asked on one of my videos if it's possible for me to do a review between VEQT, XEQT, and HEQT. And this video really was inspired by the comment that I alluded to earlier on. For the simple initial comparisons, I'm using a tool from BMO. It's BMO Global Asset Management. I will provide the link in the description of the video. It's available for those funds and ETFs available in Canada. So as long as you add them to the funds, then you can kind of compare them head to head. The 4 funds that you're comparing are HEQT, which is Horizon's All Equity Asset Allocation ETF, ZEQT, which is BMO All Equity ETF, Vanguard All Equity ETF Portfolio with ticker symbol VEQT, and XEQT, which is iShares Core Equity ETF Portfolio. As you saw from my own portfolio, XEQT is the one that I have. The rest of them I don't currently have, though at one point when I first switched to all equity investments, I started with VEQT, but later down the road, I kind of made the switch because I just wanted to have that consistency. Honestly, as you would see from later on through my comparison, I think all of these funds are fantastic choices. It really depends on your preference, and they have some small changes, but a lot more in common than one might think. All right, let's take a look at the price data. If you click on it, it does show you in terms of what was the last closing price for each one of these funds, what's the NAV for each one of them, and what was the last change. For the market, not really something that should impact your decision, just because, for example, shares of XEQT is $26 versus $14 for the HEQT and whatnot shouldn't really make a difference. It's just the share price. It doesn't talk about valuation whatsoever. So I don't want you to really get bogged down with those prices and decide, oh, I should buy shares of HEQT because it's cheaper. Not really. These days, with a lot of brokerage account in Canada, allows you to even buy fractional shares. So truly, it wouldn't matter, and that shouldn't be whatsoever a decision factor as far as I'm concerned. Looking at the fund information, all of them are traded through Toronto Stock Exchange or TSX, and all of them provide you 100% exposure to stocks. These funds were incepted at different dates. If you notice, the fund that was incepted the earliest among these four is VEQT. It was incepted back in January of 2019. Following that, we had the XEQT incepted back in August of 2019, and then the HEQT was incepted back in September of 2019. Now with HEQT, I believe it has had recently some rebranding. I believe it was previously traded with another ticker symbol. If I'm not mistaken, it was HGRO, but recently they've rebranded it. No, long story short, it's been around even despite some of the rebranding. And lastly, the one that has been incepted most recently is in fact ZEQT, which was incepted back in January of 2022. So almost 3 years after when VEQT was incepted. The reason I bring up these inception dates is that when you're trying to compare their performance, you have to keep that in mind. It's not fair for us to compare their kind of performance just based on since inception date, because some of them might have been around longer and that might have been to their advantage in most cases, and sometimes it may not have been depending on what was happening during that time period. MER and management fees are two important aspects. With MER, I think it's the one that you should typically focus on because it's management expense ratio, and as part of MER, it typically includes the management fee that you see here beneath that. So MER usually, as far as I'm concerned, based on my research, should always be higher than management fee, which is kind of odd when I saw this MER and management fee for HEQT. So I went back to their website of their own website for HEQT. Interesting enough, the intro, what they talk about here. It says the manager pays all of the operating and administrative expenses incurred by HEQT. The total management expense ratio, MER, of HEQT is expected to be approximately 0.20%. And that's, to be honest with you, what I had heard and anticipated from HEQT, which is why I was kind of shocked and surprised to see then down here, they're talking about their management expense ratio is at 0.15%, but this says as of June 30th, 2023. And then for management fee, it's actually higher, which is at 0.18%. Again, I find it a little bit kind of surprising. Usually management fee should be less because it's incorporated within management expense issue. I haven't really figured this out. If you are an investor in HEQT or have some insight around how this MER versus management fee works for HEQT, do leave me a comment and enlighten me, because I'm really, really curious about that. I did try to do some research, not necessarily the most scientific type of resource, but there is this blog that I came across, moneygenius.ca. This blog post, they talk about management fees versus MER, why the difference matters. And if I hover down a little bit, they talk about management fees includes things like the hiring of fund manager, the cost associated with that, portfolio manager services, and hiring other companies for assistance as some examples. But whereas if you look at MER, it does incorporate as part of it the management fees already. It includes the management fee, and it covers things like management fees, accounting costs, administration costs, marketing fees, legal costs, audit fees, taxes, etc. That's why MER usually is the most important one for you to be mindful of, because a lot of times when your funds have high fees, that could really eat away your actual return and performance. All right, let's move back on and continue our comparison. Aside from the HEQT, which is a little bit of a dilemma for us, the highest fee belongs to VEQT at 0.24, but for ZEQT and for XEQT, they both have the fee of 0.20% for MER. Moving on, if you look at the performance for these funds, and ideally we should look at them from common inception, it goes back as far as January of 2022, because that's when ZEQT was incepted. Since then, and it's a shorter time period, keep in mind, it's been around probably less than 2 years. Since that time frame, we are seeing that these funds across the board are showing negative returns. The ones that has the least amount of negative returns is actually XEQT, VEQT, and then you have the ZEQT. With HEQT, you see the negative 4.4%. Horizon's all equity asset allocation ETF, that had the worst performance during that common inception. If you look at the inception since the past 1 year, just to show, because all of them were incepted during that time, the best performance here in the past 1 year though belonged to HEQT. It was up by close to 19.8%. Following that, we have the shares of ZEQT up by 16.3%. Then VEQT was up by 15.6%, but XEQT at 16.6%. So the worst performance here the past 1 year was VEQT. The best one was HEQT. Again, really, really close performances, not really like huge differences. To put things in perspective, though, HEQT really differed itself from the rest of the bunch, definitely by close to 2 to 3 percentage points. And if you look at since inception, which as I indicated, it's not the best comparator. The reason I'm showing you the performance since inception is more so to show you how these funds almost move virtually in the same direction all the time, because they are all giving you exposure to the entire stock market one way or another. The percentage point might be slightly different. Some might have more exposure to US, some might have more exposure to Canada, international, emerging. But at the end of the day, the directional trends that they're showing are very much aligned. So you see how they nicely go up and down at the same time. I'm not surprised if you see here, for example, the shares for BMO or like ZEQTs are a lot less in terms of performance, because it's been, as you can see, the bar started showing up since early January, because that's when it was incepted, and the VEQT had its inception way back in 2019, early 2019. Just wanted to point that out for you. If you look at the return based on different time period, the year-to-date return shown here is the best one belonging to HEQT at 13%. Following that, we have a close tie, almost at 8% for all of them between ZEQT, VEQT, and XEQT. The 1 month return, all of them are down close to 4%, anywhere between 3.7% to almost 4%. 3 months return, you do see that they're all down as well. HEQT was down the most by 3%, and then for VEQT, XEQT, and then ZEQT, they're hovering around that negative 1.6% to 1.7%. 6 months return is shown here, and as well as 1 year return. As I pointed out, the return in 3 years is not, and this is annualized, of course, the return 3 years annualized is not being populated for ZEQT because it was not incepted back then. What's interesting is that if you look at the return since inception annualized, with the exclusion of, I would say, ZEQT, because that's probably not long enough time period for us to really assess it. But for all of the other ones are hovering around that 8%, and which is very much what you can expect over the long enough time period from the stock market, around that 8% mark on average. And probably that's a safe number if you're investing for the longer term to consider when you're planning for your retirement and what type of average return you can see over the next 20 to 30 years as an example. For the fund data, we are just going to quickly look at the distribution frequency for the dividend yield. What's interesting is that VEQT does pay its distributions on an annual basis. As for ZEQT and XEQT, they do pay them on a quarterly basis, and HEQT does pay it on a monthly basis. Now, HEQT, before its rebranding, used to actually pay a very low dividend yield, and it was actually paid only annually, but they have switched it seems like, to now monthly. And in fact, if you look at it, the yield seems to be indeed higher, because if I hover higher, it's just show you the annualized distribution yield is around 2.15%, which is very much closer to what you see for the rest of the bunch, with BMO closer to that 2.3%, with XEQT close to that 2.1%, and for VEQT closer to that 2%. Lastly, I'm going to show you the different holdings. How much exposure do you get by holding on to different funds? With HEQT, it mainly consists of a number of other ETFs offered by Horizons as its underlying assets. It has Horizons US Large Cap Index ETF, Horizons NASDAQ 100 Index ETF, and these two come to about that 45% or so weightage to the US market. Following that, there is about 25% exposure to the international developed market. This excludes Canada and US, around 20% to Canadian markets, and roughly 10% or so to emerging markets. So here, if we compare this as an example to XEQT, your exposure to the emerging markets is higher, because with XEQT, you get less exposure to emerging markets. For instance, let's quickly show you the holdings. With XEQT, you get about 5% exposure to emerging markets. You have somewhat similar, I would say, maybe even higher, slightly higher exposure to US market at around 46%. With international markets, you get around 24-25%, and Canadian markets, you get around that 24 to 25% exposure as well. With VEQT, if you look at it more closely, you are getting exposure to around 44% US market, roughly 30% to Canadian market, so slightly higher exposure to Canadian markets for VEQT. For international developed markets, excluding North America, you get around 19% to 20%, and the emerging markets, you get around that 7% or so. The uniqueness with VEQT is higher exposure to Canadian market at around 30%, which was based on some of the research that Vanguard had shared, why they think around 30% is the optimal exposure to Canadian markets. And lastly, if you look at the ZEQT fund by BMO, here you get exposure to US, approximately, let's see, around 44% to S&P 500. Then you get another 4.5% to S&P US Mid Cap Index ETF, and around 1% to S&P US Small Cap Index. So if you put them all together, that comes up close to 47 or 48% exposure to US market, around 8% to emerging markets here. You have around 20% exposure to international markets, excluding North America. And lastly, approximately 25% exposure to Canadian markets. All in all, it really depends on what's the target market exposure rate that you're aiming for. I think they are all great choices, and really, it really boils down to personal preference and what you're aiming for. Do you rather perhaps get some of those dividend distributions more frequently or less frequently? If you prefer less frequent, probably Vanguard VEQT fund would be the best one. If you prefer more frequent receiving of those, probably the HEQT would be a good option for you to consider. And for those of you who may be kind of in between, the choice might be around XEQT or ZEQT as alternative ones, as they do pay their dividend distributions on a quarterly basis. By the way, if you have not already downloaded Blossom app, I do encourage you to absolutely do that. I'm very active on Blossom. It's an amazing community of over 60,000 Canadian investors who are sharing their journey investing in the stock market, their recent trades, what they're buying, what they're selling, and any of the questions that they have. It's a very supportive community, and I think you are going to absolutely love it. To easily refer to this community and download it, refer to my To download the Blossom app, I do encourage you to use the referral link that is provided in the video description. It provides you some bonus and gets your journey started much quicker here on Blossom. Well, thank you so much everyone for watching this video until the end. I hope you enjoyed it and gained something of value from it. Let me know what your thoughts are. If you have any questions around this video or any of the contents or videos that I've shared so far. If you have topics that you'd like me to cover in future videos, I would love to hear from you. Thank you, and I hope to see you all next time.